Hello and welcome to the Humans of Growth podcast, where we talk all about the stories and strategies behind business growth and development. I'm your host, Aly Hathcock, and today's episode is sponsored by Parison Network, the new way for brands and businesses of all shapes and sizes to find the right marketing partners. If you're looking for marketing support but don't know where to turn, Parison Network has you covered. You can go to parisonnetwork.com to schedule a free strategy session today. Today's guest is Ben VerWys. Ben is the founder of Fiduciary Financial Advisors. FFA is a fee-only wealth management firm that helps people plan, invest, and protect their future while also always putting client interests first. Ben, welcome to the show.
Thank you.
So, Ben, I introduced the professional side of you, but I would love to tell me about the human side of you and what's bringing you joy right now.
Yeah, well, I'm a father of two and two teenagers. So, it's a juxtaposition. Sometimes there's joy and sometimes there's frustration. I also realized that part of why I love the work professionally I do for a very long time, but one of the things I also really love about it is it affords a lot of flexibility and creativity in terms of lifestyle. So I have a lot of hobbies and try to, I dislike the term work-life balance, but I also definitely make sure I have plenty of it. So it's always.
What do you do? What do you do for fun?
Boy, I think my wife would say I have too many hobbies. I'm an avid skier. I am a live music aficionado. I love going to concerts. It brings me joy one-wheeling into my office. A lot of my daily commutes are on a one-wheel. It's everything from mountain biking and hiking to, I guess, traveling the world. I spend a lot of time traveling and have designed my professional schedule to accommodate that. So, an avid reader. There's all kinds of stuff. The list is probably way too long for this, Aly.
I love that you're one of the few founders that I talk about whose entire life is not work. So I appreciate
that. Wasn't always true. It's been an evolution.
Yeah, where do you like to go skiing at?
I'm happy skiing in a lot of places. I most often find myself in Lake Tahoe or Colorado because I'm in a part of the world where I don't have a lot of flight options, and so somewhere near Denver is the most frequent just because it's a rare direct flight option.
Okay, cool. I love it. So, Ben, you started FFA almost 11 years ago. I think November 11 years ago. What made you decide to start it?
Yeah. I think every founder thinks their origin story is unique, and I still think mine is unique. But I'll try to keep it briefer because there's definitely an origin story that's still very much a part of our ethos today. Mm-hmm. It still drives what we do. The short version is, or the medium version, I guess, is I knew this was the work I wanted to do from a young age. So it was always going to be something in investment and financial management related. I am a fairly self-aware person and pretty early on came to the conclusion I didn't want to sit in a cubicle and crunch numbers, which ruled out a lot of the analyst trading type work, and loved the people side. And so I went into this early. I actually got my first financial advising job at 18 as an intern in the insurance channel, and I went to the office more than I went to classes. So that's kind of that's the origin story of getting into the work.
Yeah.
And then after that, I did a tour in the military and kind of lived around the U.S. for a number of years. And in my mid-20s, decided to come back to where I am in the Midwest and re-enter the financial advising world. And this was in 2007. So there weren't a lot of jobs. I did about a year and a half in the bank channel before I got recruited away to where it would eventually become my home for many years, which was working for a 4-person team at a large publicly traded broker-dealer, and loved the work I was doing, loved the clients, but the irony of a 4-person team when you're the youngest one is like there's not a lot of turnover. There aren't ladders to climb. There aren't opportunities for promotion. So what I did after the first few years, I got really good at my job, and we didn't grow a lot. We didn't take on a lot of new clients, so I didn't have to. I didn't have to, work very hard to do a pretty good job at my job, which for somebody in their mid-20s means you get bored pretty quick. And so, in an effort to stymie my boredom, I used my GI Bill from my military tour and went to night and weekend classes to get my MBA. And the MBA journey is really the origin story of this, because I went into that with some questions. I loved the team I worked for, so my questions weren't a negative reflection of them, but I had a lot of challenges and concerns. And from my vantage point, all I ever wanted to do was work in the financial advising industry. I probably needed to be able to do that for the next at least 30 to 40 years, and I didn't like a lot of what I saw. So I was asking existential questions like, can I do this work for the next 40 years the way it's done and be happy with it? And so I had questions like, who came up with the 1% management fee and why? And why are so many financial advisors employed by publicly traded entities when the publicly traded company has a mandate to put a shareholder first, but we say we're supposed to put a client first? Like, how do you reconcile these things?
Yeah.
So the origin story was a lot of naivete and idealism and some boredom mixed in with, at the time I was already, at a young age, managing almost $1 billion at a high level for really wealthy families. And you add all that up, and my MBA experience was one where I went in trying to figure out if there could be a better way to do the work. Yep. And it didn't feel like to me there was a lot of innovation or anything different in a long time in our world. So 11 years ago, I kind of, through that thesis, developed out what I thought would be like an ideal firm, both to be a client at and an advisor at. And it ended up being a whiteboard project that in that design, I went looking for a firm like that to see if I could work there, because I had no real entrepreneurial desires. And the problem was I couldn't find the firm. I couldn't find a firm that allowed for the type of autonomy and control and income upside and prioritizing clients and fiduciary duty and all these things. And so kind of came to the grim conclusion that if I wanted to work for a firm like that, then I would have to start it. And that's the origin story. And that's what I did.
I love it. Was it just you starting from the ground up, or did you bring in?
Yeah, day one, it was just me. Year one, it was just me. Year two, I hired my first employee, who was a college intern and a graduated senior. And, the rub at the time was I'd already given up my income from quitting my job at the broker-dealer. But in year two, I knew I didn't like doing paperwork, and it wasn't my highest and best use of time. So that meant if I was going to not do paperwork, I needed to hire somebody, and I paid that college intern turned first employee more money in year two than I took home in pay. And so that was kind of then from there. In year three, we added our first advisor separate from me, and it's been kind of that extrapolated ever since.
I love that. And I love that your first hire is like, let me get the paperwork off of my desk.
Because being former military, delegation is not something I struggled with.
So in the world of financial services, everybody claims that they put clients first. Whether they do or not, it's a little bit questionable sometimes. Sure. How do you stand out? How do you differentiate and say, when everybody's saying we put clients first, how do you do messaging and not just messaging, but show up differently?
Yeah. That's a great question. There's two sides of that, in my opinion. Like at so many things in life, yin yang, two-sided coin. Yeah. There's the what do you need to do for it to be true instead of just cheap talk. Yep. And then you've got another question in there that I really love, which is like, what does it actually mean in terms of what you practically do differently? Because somebody could do the first part and not put a lot of thought into the second part. And the first part is sort of taken care of in our licensing structure and our commitments and our legal agreements. Okay. Right? And I'll share those with you. But I actually spend more time thinking about, like, those are table stakes for us. Then we think a lot about, once those particular table stakes are set, how do we then make a great experience, not just for a client, but also for an advisor. And as the owner and founder of the firm, we kind of view us as having two different clients. We have clients, what every financial advisor has, and clients. But we also have FFA has turned into a platform and a cooperative where we don't see the industry doing a good job prioritizing advisors' interests, and they're also our clients. So we've gone from just me to, I think, 43, 44, 45 advisors in the last few years, because that's where we can, so anyway, here's the answer to your question. Side of the coin one is I viewed the premise of taking good care of clients as not something that could be subjective. So in that whiteboard exercise I did in grad school, one of the things that I did as an experiment, which was fascinating, it was time consuming, I wouldn't do it today, but I'm glad I did it, was I had an assignment to go and pull what different financial advisors and different financial advising firms on their websites said made them different, right? And then I had to keep a tally list. And it turned out they all said the same things, which is a complete oxymoron, right? It's that what makes you different is definitely not different if everyone else is saying the same thing. The second problem there was that it was all the kind of stuff that the end-facing consumer had to just take their word for. There was no quantitative proof so you'd see things like, as an example, you'd see like, we care about our clients, or we strive to provide amazing customer service. And it's like, well, I don't actually get to find out if that's true until I become a client. So, yeah. So one of the paradigms that we did is we said, okay, our value proposition cannot be subjective. It has to be specific things that are fact and provable. And so it became kind of a three-prong landmark of what makes us different. Number one was no one was allowed to have any brokerage licenses of any kind. So we had to have a fiduciary duty, which meant Series 65 or CFPs only, advice-oriented work, no commissions, no trails, nothing that somebody could say wasn't in their best interest.
Okay.
Which is a very small percentage of our industry. At the time when I launched, I think there was Price Metrics did a big study. Unfortunately, they got bought out, so you can't get the study anymore, which I really enjoyed the study, and it would find out how many people only had a Series 65 or CFP and no brokerage licenses. And at the time of my launch, I don't think it's changed a lot. It was something like 6 to 7% of the industry. So that meant 93% of people who said they had to put clients' best interest first were just plain lying or wrong or ignorant. One of the two.
Will you, for people who aren't in the finance space or listening, will you break that down, all of that jargon for us real quick?
Yeah, absolutely. Yeah, sorry. Happy to. 93% of financial advisors do not have to put their client's best interest first. Okay. What that means is they can sell products that they benefit from, whether the client does or does not. And almost 100% of clients, when they get polled, say, we don't want that. And yet, almost everybody statistically still works with or hires somebody who does not meet this. And now you're seeing what our world calls a hybrid, where and so I guess I'll back up. The type of licenses you have in our world dictate what you can do, how you can do it, and also dictate how the consumer public should view an advisor. But the problem is the consumer public has no idea what these licenses mean, right? So your question a minute ago, if I say a Series 65 or a Series 7, the average person in a coffee shop has no clue what those mean.
Right,
and they're two completely different licenses. One allows me to screw somebody, and one allows me to not function in a way where I can. It's like 180-degree difference. So there's licenses that allow advisors to sell products, get paid commissions, be off the hook for how well their investment recommendations do, and disconnects their compensation from how well their client does. So that's key, right? It'd be like if you went into surgery just hoping your surgeon has to do the right thing. I kind of like to know they need to. And without throwing names under the bus, almost every firm that anyone who would listen to this podcast has heard of, the big ones, the banks, the insurance companies, the broker dealers, they're all in this boat. And they can get sort of like go-between licenses that allow them to act as a fiduciary sometimes, but not always. And the end client never knows when they are or aren't. And it's like two hats that they can just take on and put off. And, and so it's really muddy. The whole thing is really muddy. And so one of the ways that we differentiated was by saying, let's cut through the noise, cut through the mud, and have a licensing structure where everyone knows that how we act, whether they know what a Series 65 or not is, doesn't matter. When we call ourselves Fiduciary Financial Advisors, and we often explain what the word fiduciary means to people who don't know, which is we have to put your best interest first. Is that how you want it? So that was a big piece of it. The second piece was Wall Street and financial services in general is pretty greedy, right? I mean, if you've never, we joke, but we're not really joking. You've never seen a Hollywood movie where somebody wasn't getting screwed, from Wall Street to the Wolf of Wall Street to the Boiler Room. Right? So there's this general public awareness that like not everyone is good in this space. Not everyone has good intentions. Not everyone has good motives. And not everyone's Bernie Madoff either. Sometimes those intentions and those motives aren't somebody getting screwed. They're just really high fees. They're higher than necessary fees. There'd be like, one gas station that says, I know all the other gas stations around me are $3.50. I'm going to put it at $5, but no one advertises their prices, right? So it's like, you don't know if $5 is bad, and no one is transparent about it, right? Yep. So what we did was, another thing we did was said, okay, talk is cheap, figures are real. We don't want subjectivity. We don't want somebody to have to ask, like, am I getting a good deal? Am I paying too much? What's normal? So the entire industry of our world said, okay, if you're going to be a fiduciary, we're going to all agree that about 1% and higher is the normal fee. Real estate does the same thing. A lot of people bought houses and they're like, oh, it's just 3%, right? Our world did that, and that was one of those questions I went to grad school with trying to figure out, and found out it was just organized collusion. It was the big firms saying, like, we're all going to stay around here. That way we can all make a lot of money, right? And so we said, well, that doesn't make sense to us. We're watching large firms use client dollars to build up legal kitties, to fight against the clients, to advertise at the Super Bowl. Those are the extreme examples, but use money poorly. And that's the client's money. So we said, well, what if we didn't do that? What if we ran a leaner business? What if we had more of like a cooperative or a credit union type model where we charge less and let the clients keep more of their own money in their pocket, and we just ran a less profitable business? We could still run a good business and do great work. Could we run it for less? So that became our second important value proposition that was totally different. So we set our highest fees below the rest of the industry's lowest fees, and then figured out how to make a good business from there. So those are the key ones.
Yeah, and it's really interesting once you kind of dive into it, how difficult it is for consumers to understand what's actually going on. Because in a way, it's like you're going to manage my money the same way you manage real estate, where it's a percentage. Okay, well, what's normal? Why is it a percentage? And for the most part, all the information that's getting put out there, I would assume, is on behalf of products that people are getting commission for. So how do you actually, it's like when you see like a list of top 10, it doesn't matter, toasters, they're getting affiliate fees for all 10 toasters. So how do you know which one, if those are actually the top 10 toasters, or that's what they have affiliate fees for?
Yeah.
Same sort of concept.
That's a good observation. And unfortunately, our world, there's definitely, what you just said is true on the product side. It's even more true on the brand side. Okay. So I promise I'm not picking on a brand just to pick on a brand. I could pick on any of the brands. It doesn't matter. But if somebody Googles the best financial firms, guess which ones are going to come up? It doesn't mean best qualitatively. It means biggest. Guess which ones are the biggest? The ones that, are the publicly traded. And so, for instance, Merrill Lynch has 16,000 financial advisors, and they're owned by Bank of America, and they're publicly traded, and so they're easy to pick on. So they're probably going to be on that list of best, for anybody listening, I'm using air quotes because that just means biggest, right? It doesn't mean best. They
Yep.
could easily be the most expensive. They could easily not have a fiduciary duty or have to put clients' best interest first. In fact, they have bosses at Bank of America who will tell them what to charge, what to do, how often to do it, when to do it. And so you see this conflict ridden throughout the system, but nobody knows about it. And that's the challenge.
Yeah, and it's interesting because I help people get connected to the right marketing agencies, and it's the same thing with agencies. It's the same thing with lawyers. It's the same thing with real estate. Whoever has the most money to spend on Google Ads is whoever's going to show up first. Whoever has the most money on marketing, whoever
Sure.
is best at search engine optimization for themselves. But whoever shows up on Google, doesn't matter what service, it doesn't mean they're actually the best 9 times out of 10.
Yeah, and can we take that even a step farther? In our world, who has the most money is a mathematical byproduct of two things. Who charges the clients the highest fees and who pays their advisors the lowest amount. Those two inputs drive who has the most profit left to go acquire, expand, grow. So the reality is consumers for many decades, and it's starting to change generation, but consumers viewed big as reliable, viewed big as, they're going to be there. And we even see it in television commercials all the time, maybe at the behest of the marketing groups you're talking about, of like, talk about how long you've been around. It makes people feel comfortable. So you'll see an insurance company in a TV commercial that'll say, we've been in business for 100 years, right? And it's like, well, that might not actually be a good thing. You might be in business for 100 years because you've been exploiting people for 100 years. And I could stay in business for 100 years if I was doing that too, right? So in our world, when you charge clients more and you pay advisors who are the ones doing the work, it's called a trusted advisor, except they're only trusted by the client. They're not trusted by the firm. So therefore you pay them less and then you lock them in with restrictive legal agreements so they can never leave.
Mm-hmm.
Just to leave their firm, they have to leave the entire industry. This is rampant. That's who grows to the top of the best list because they're the ones who have the most money to throw at.
Yep, it is. It is very much the Wild West.
Yeah.
Yeah. So with you guys, 11 years. What are the biggest growth levers that you've seen that have actually moved the needle in the business the most?
Yeah. Okay. Good question. One was the choice to move beyond kind of a me and an assistant, a me and a few other people model, and go to a true scale model. And for the first 4 to 5, we're 11 years in, but honestly, it's been 2 different chapters. And if you'd have asked me in the first 3 to 4 years, I would have fought kicking and screaming until I knew there was no way I was going to scale a business.
Mm-hmm.
So I wanted a lifestyle and I wanted to do work I loved, but I didn't have any interest in managing people or getting big or what have you. It sort of happened by accident, and there was a growth lever along the way where, as all this accidental growth was starting to ramp up around years 4, 5, 6, the mindset shift from reluctant grower to willing grower, not just for me, but for several of my key team members, meant we started taking more. We don't. 2 levels. There's an important distinction. We grow fast. We grow a lot, but we don't buy that growth. Our marketing budget is 0. So I apologize to your marketing firm clients who are spend money with somebody because we don't need to market to grow. It was kind of the field of dreams thing where, like, if we built a good enough model, we felt like clients would be drawn to that model. Not everyone, because there's still lots of deceiving happening, but enough people would cut through the noise and start to realize fees mattered and a fiduciary duty mattered, and they would find us. And that's happened. And then the second thing is that, if we had a better advisor experience for people working here where they truly were prioritized and empowered, then that would so all that to say, we don't market at all. We don't market to clients. We don't market to advisors. Everyone who we work with is organic and finds us. We also don't do acquisitions. So what that means then is when you flip from a mindset of reluctant grower, kind of non-growing, reluctantly growing, to willing to grow, we were willing to take a lot more of those calls and say yes a lot more than we had not and had in the past, right? And that meant through conversations we'd have, whether it was with somebody like you or a CPA or attorney, they would know we were willing to take people on if they were the right kind of people. So that was a big growth lever because it achieved scale in the sense that we went from, I think, within a couple year stretch, we went from maybe 5 to 8 advisors and 10 to 12 employees up to 30 really quick. And we haven't looked back since. I mean, we had 15 to 20 people head count a year now at this point. And that's like clockwork. And we've never posted a job description or we've never hired a recruiter. And so we know we could even get the growth to happen faster, but we already feel like we want prudent managed growth because we also need to provide a really great client experience and a really great advisor experience. So too much growth could break either one of those. So the first year we from a growth company perspective, kind of one of the main measures there is the Inc. 5000 list. We made it the first year 4 years ago, and that kind of was a moment of like, oh no, are we growing too fast? Is this okay? Like we're excited we got this thing, but also like, and our thesis was like, well, we're doing the right things. We can see in the data we're doing the right things. So let's just do more of the right things and keep a close eye on. And that became its own lever where using the culture and the data that was already working to then double down on it.
Yep.
Just kept that momentum going. Right, and we just got. I think we just had our 4th year in a row where we've been on the Inc. 5000 list, and that's sort of a symptom of. It's less a lever like a lot of companies might say. We're like, oh, I went out and got this technology, or I went out and did this acquisition, or I went out and hired this key person. We did hire. We hired a few years ago our day-to-day CEO who oversees a lot of the firm day-to-day operations because I still run a book of clients and that was a nice lever of growth too. We've seen a lot of increase as we've had a more robust team and particularly kind of right seat on the bus type of instead of just jack of all trade type of approach with team members. But obviously that costs money and so it can't be done too swiftly or too expensively.
Yeah, and I think one of the things that's interesting about you guys is from day one, you had spent a lot of time on market research, more than most founders do. And you came in with the intentionality as well as to some degree, I think, the structure of this is what we do. This is why we do it. Here's even like the business structure that we operate under. I think you came in with a lot more than most founders do. And because you had from day one such a solid brand positioning, marketing is still important. I'm not going to say it's not, but you had something that I see other companies have to use marketing to compensate for not having a differentiated brand enough. And you have such enough of a differentiated brand that to some degree you don't need to do as much like traditional marketing as everybody else does.
Yeah, that's absolutely true.
And I think that's what makes you guys kind of special. And that's what makes you different. Because I've talked to a ton of founders. They don't and because a lot of us come in and we figure it out as we go. And
we're still doing some of that too.
And listen, there's nothing wrong with that. Like that is 100% my life, and I love that sort of style of growth. But you came in kind of like having all the pieces in place already.
I think we had the ideas in place. I appreciate you saying that. It's probably generous to say we had the pieces in place. I can give you an example where you're right. We didn't spend money on marketing. And I know a lot of businesses, and we work with a lot of business owners as clients too, right? So we see this. I'm a certified exit planning advisor. I do exit planning consulting. So we work with a ton of business owners, and it's interesting how they all come at a lot of the same problems, but from totally different places. So an example where we didn't spend money on marketing, but a minor shift in our thinking that we weren't even thinking about in the inception or through the early years Like we'd always felt like taxes were important, but most of the world kind of viewed as the CPA's problems, right? And so about, I want to say it's been maybe 6 years into the growth, 6 years into the company, so 5 years ago,
Hmm.
we stumbled across a software that allowed us to do a lot deeper dive tax planning.
Okay.
And it didn't become an a la carte separate service for us. In some businesses, it might have become a different revenue line or whatever. Tax planning was so intertwined with financial planning and retirement planning and business planning, which was so intertwined with financial planning and life and investing that, like, we just said, a bunch of us said, well, we could get better at this thing. And we don't do much of it right now. And
Yeah.
so we started using that software and gathering our clients' tax returns and putting those through kind of an algorithmic test and started talking about that. Just one minor change in the value proposition without breaking all the previous stuff, fiduciary duty, lower fees, all this
Yeah.
stuff, but also saying, like, we think the world, more or less, the general adult population, a population in the United States, who everyone has to file a tax return, we think most of them have no idea who to talk to or to find out if they're paying too much.
Yep.
And what
100%.
if we threw that into the mix? And we only started throwing, we didn't start advertising it. We just started bringing that to our existing clients.
Hmm.
And no surprise, outside of the limited amount we'd done for them, and we'd never asked them for their tax returns or anything, they were thrilled. And in its own way, it was a form of marketing because we watched our referrals go through the roof when we started doing tax planning, like real tax planning.
Yeah.
And it was immediate. What we found was a lot of people had a financial advisor who they typically associated as somebody who managed their investments and maybe did retirement planning.
Okay.
Almost no financial advisors do a really good job helping people pay less in taxes, cut through the noise of what taxes are, and improve that whole aspect of things, collaborating with the CPA. And so it was its own form of marketing. So from a business perspective, we could throw a lot of money at marketing, sure, SEO or whatever, but we'd rather solve problems that make us
Yep.
more hireable and then let that work speak for itself. That's our version of marketing, right?
Yeah. How did you come across this software? Did you have time set aside for like research and development at all?
Yeah, I mean, we do. We attend some conferences where there's like tech expos and vendors, and there's some industry podcasts that with some people who are kind of at the forefront of all of that. I want to say that's where I discovered the software. Was that we also stay at the kind of the pulse of what's going on at the front of our industry. We're a much younger average age firm, which is a good thing. Whenever somebody hires a financial advisor, you want somebody who's going to be with you, for your life. And if they're,
Right.
near retirement, that just means you're gonna have to start back over again pretty soon.
Yep.
So we have a tech savvy younger advisor base who is willing to scope those things out. Sometimes our team brings us stuff that they've heard about. Sometimes that one I think I discovered at a conference or through a friend in the industry who was kind of on the cutting edge, and we're nosy and hey, what are you guys working on these days? Kind of thing.
Yeah, I love it. So I wanted to go jump back to something you said. It's been a little while, but the mind shift that you made from I don't want to manage people and I want to stay small to now I'm going to grow and scale and manage people. Tell me about the decisions that went into that because I know a lot of small business owners they get into it because they love their craft and they love
Yeah.
doing the work, but they know but the wealth for them is like, no, how do I, it's like I'm going to scale, but then to some degree you are having to kind of step out of the work. And a lot of them don't want to manage people and you have to manage people. So tell me kind of about that journey for you.
Yeah, first off, you're so right. I mean, I tell a lot of financial advisors who are thinking about starting their own firms because that's their kind of default. I don't want to work for the man for a big box Wall Street shop, so I guess I have to go start a firm. I mean, that's really why FFA exists, is to give them an alternative option where they can have autonomy. But a lot of advisors, I talk about Michael Gerber's E-Myth concept that they're most people who start businesses do it because of a technical proficiency that they can deliver to the world, and they can deliver it in a better way than what they saw wherever they worked. And that's like 70 something percent of business startups in his research. So I came into this saying, I don't want to be told how to do the work, or be told what products to sell. And not wanting to manage people was kind of like the assumed thing I would need to do that was involved with scaling business, which doesn't mean it's wrong. Some of those things are unavoidable. Some of it is honestly just head trash. Some of it is like, you know what, but my priorities have changed, my vision has changed. And so, like a lot of entrepreneurs who are kind of high quick start on a Colby scale, or a high, if you're going to do that kind of mental shift, you need to be able to make pivots, and you need to be able to throw away who you used to be or what you said you wanted to do. And I had to do all of that. Along the way, to try to answer your question, what had to happen, good support goes a long way. Having a good team, being good at delegating goes a long way. I had to learn to get even better at delegating, and I already had a pretty good foundation coming out of the military for that. Also, taking a little bit of a longer view had to change. Like, I had to double down and buckle up for a way longer ride. But also along the way, something happened for me that I know has happened with other founders. It doesn't happen a lot with technician-oriented entrepreneurs. Is my kind of capital WY morph from wanting to be a great advisor into wanting to build a platform that I felt like the financial advisor world badly needed and didn't really exist.
Okay.
And so that meant signing up for a completely different workload and making completely different decisions, right? And there's a lot of gravity to that kind of mental shift. So I wouldn't encourage entrepreneurs. Don't scale for enterprise value. Don't scale because you want to sell. Don't scale because you don't know what else to do or you're bored. Go get a hobby. If you're going to scale, do it. There's only one good reason I think, for me to want to make that pivot and scale. And it's because you're solving a way bigger problem in the world than you first set out to solve. And some entrepreneurs know right at the beginning that they want to solve big problems. I didn't. So I had to make that shift, or I had to stay where I was. And I met so many financial advisors along the way who were the technician people who just wanted to do great work for clients in a way they felt really good about, who frankly shouldn't start their own firms. This isn't like my view. This was Michael Gerber's view of, like, very few people are actually the archetype who should go scale a big capital WY type business. And most of the financial advisors I'd met who'd started firms weren't that. So then this new kind of mission came about. Another thing that happened was I realized that, like, part of why I was reluctant to scale too was that I was afraid I would have to make concessions and break culture and, like, give up these things that were really important to us.
Yeah.
And I had a lot of people tell me, oh, it's great that you guys don't have vacation policies or dress codes and no bosses to tell you what products to use or anything. I've had a lot of advisors say, like, kind of like, compared to what we're used to, it feels like the Wild West. There's a lot of guardrails. There's a lot of safety mechanisms. It's not the Wild West, but optically from the outside, it kind of can look like it when somebody's used to a more standardized world. And I had a lot of people in my world say, like, oh, by the time you have 20 or 30 advisors, you're going to have to abandon all of that. You're going to have to have policies, and you're going to have all this stuff. And so the whole time we've been kind of sitting here just like, is that true? Do we have to change? Or can we just is it possible to keep going and doing what we're doing without having to make those concessions? So we're always very much on alert of, like, corporatization, standardization gone wrong. And some of it is like the small giant philosophy, right? Some of it is, I'm not arrogant enough to say we are a small giant, but I am in pursuit of some of that small giant mentality of being a great company that is no longer small, that is also no longer massive, that is never going to be massive. If we want to be massive, we'd be doing acquisitions and we'd be borrowing money and taking on investors, and we haven't done any of that. So we're pretty committed to being a small giant, maintaining these things that are really important to us. And we always say it, we'll keep growing and we'll probably keep growing fast. But the moment we start, if those concessions sort of rear their ugly head, then we probably would go a very different direction again. Oh, does that help?
Yeah, absolutely. So eventually, I'm assuming you're going to retire potentially.
My favorite question you could have asked.
We're going to pretend. We're going to pretend. So you're at your retirement party. Friends, family, colleagues, coworkers, neighbors, everybody's there. What is the one story or the one moment that you would retell from your time at FFA?
Like so many entrepreneurs, it's hard to answer your question because, like so many entrepreneurs, I spend so much of my time thinking about forward and very little about back that I bet if you asked my team right now, they could come up with a laundry list of stories, and my response would be, "Oh, I forgot about that." Right? Like I know there's formative moments, and I think that it's easy to pick on a bunch of stuff, but there isn't just one. There's, I guess I'll give you one. I'll give you the best answer I can come up with in the moment, which is, and I didn't know that you were going to ask that question. And I think sometimes when I listen to a podcast, I'm like, I wonder if the person knew that was going to be the question. I did not know that was going to be the question. I think in the moment there was an event that happened probably about year 5 or 6, probably year 5, maybe 4. I guess it would have been year 4. It was right before COVID, and I had enough success that there was a conversation I had with my wife, and it did not go well in the moment, which is why it's part of the story. It wasn't like a routine conversation. I, at the time, was reading the book Grit by Angela Duckworth, and Angela Duckworth in that book Grit talks about how part of grit is more than just loving the work. There has to be depth and gravity and meaning to the work. And a lot of technicians start financial advisor businesses because they love being financial advisors, or fill in the blank for any other industry. And she uses the example in that book of a bricklayer. And the bricklayer who actually really enjoys laying bricks, when somebody asks him what he does for a living, he says, "I lay bricks." And there's another bricklayer who also lays bricks, builds the exact same kinds of buildings, could be the same age, could be everything being equal. Somebody else asks that bricklayer what he does for a living, and he says, I build important buildings. I build, and he kind of morphs his thinking beyond, I just lay bricks, I build important buildings. And there's a third bricklayer who is much more rare, and the other 2 bricklayers kind of think he's an idiot and aloof and lost to the clouds. And somebody asks the third bricklayer what he does for a living, and he says, "I change the world." And the other bricklayers are like, "What?" And then that person asks him to explain and expound, and he said, "Well, I lay the bricks that become the foundations of churches and schools and governmental buildings that will, that will carry civilization for the next 300 or 400 years." And all of them are laying the exact same brick the exact same way. And so the answer to your question about the story is, I read that part of the book and I was blown away, because I was right in this sweet spot of I think I can start to take some time off and prioritize some lifestyle stuff. And I spent a lot of time away from my wife and kids in the early years, and putting them to bed and then grabbing my laptop and working until the wee hours of the night. And I'm a big believer in sort of doing what you need to get through. I hate mornings. I think it was PTSD from the military. And so I forced myself during the early years to schedule 7 a.m. breakfast meetings 4 or 5 days a week. So I'd be up early and gone, and then I'd be working late. And I think this was right around the time where my wife was hoping I was going to kind of cut back and start to spend more time with them. And then I read this book, and I was so excited to tell her about the bricklayer. So I told her about the bricklayer, and we're sitting on the couch, and I'm excited about it because I think it's great, and she thinks it's the worst thing I've ever told her.
Oh, no.
And to her credit, I didn't see in that moment that balance, yin yang, have your cake, eat it too. I am telling her okay, I just built up this practice that's gotten us a lot more income and fulfillment and than I ever could have had as an employee, and now I want to keep going. And she's like, I thought you were going to back off. And there was a couple year stretch where it was this sort of push pull between trying to be present for my family and think about health and other things a little bit and not let them all just be by the wayside like they had been, but
Yeah.
not lose sight of that third bricklayer mentality that eventually became the foundation, pun intended, for what we are today. And I think that moment of like having to wrestle with, is she right? Do I need to toss the third bricklayer altogether and just be the second bricklayer? And then the follow up. So that's the story I think I would tell, is like that decision to go from a small business to a medium business was everything, because the small business didn't need a big why, and to justify going to a medium and eventually larger business, it needed to be a big why.
I love that. Thank you for sharing that story.
By the way, oxymoronically, I do retirement planning for a living, and I don't actually personally believe in retirement. I have to caveat that. I don't think I will retire because my industry doesn't require that, and I love the work I do. And I have had advisors retire out of here at 78, 77. Like, we can go a while in this space. Maybe someday I'll.
Cool. I love it. So, Ben, thank you so much for coming on the show today. If people would like to connect with you further, what's the best way for them to find you?
Yeah, I'd love to have anyone reach out, from somebody who's looking for a good financial advisor to do the work the way I've just talked about, or if anyone listening is a financial advisor and you're thinking about starting a firm or already started a firm. Actually, a lot of the advisors that join us close up their own because they're sick of dealing with the headaches. So please reach out. We're online at www.forfiduciary.com, like for a fiduciary.com. I'm looking for a fiduciary. I'm on LinkedIn. I'm not on there a ton, but I'm on there regularly enough. Would love to have anyone connect with me on there. My contact information and more about our team, more about me, are all on. Those are really the two best places.
Awesome, thanks. And we will also, there's all that information will be in the show notes for anyone tuning in. Thank you so much for joining us today. And if you are looking for a marketing agency, you can skip the grunt work and schedule a free strategy session over at perrysonnetwork.com. And we will catch you on the next episode of Humans of Growth.
Thanks, Aly.